Hello, folks. Appreciate your patience. We are just waiting for our second panelist, James, to enter the Zoom room as well, but we thought we'd get kicked off. Oh, looks like James is in the waiting room. So, um, my Gavin, if you see his name, you can push James Schechter to attend to panelist. Um, so in the meantime, I'll kick off with a quick introduction to myself. My name is Noor Chaudhry. I lead community and partnerships at Sydecar and have done so for about the last 2 years. Before that, I led platform at a venture firm called NextGen Venture Partners that used SPVs as part of its co-investment process, and did that for about 3 years, supporting on all things diligence, SPVs, and beyond. So really excited for today's topic. This is coming off the back of a data report that we released about carry, management fee, and I'm excited to get the real perspectives in the call today. So without further ado, I'll give the mic to Amr to introduce himself and then James.
Hey everyone, my name is Amr. I'm a GP at Carmen Ventures. I started my career in venture capital a long time ago, but left to get operating experience. I worked at Uber for 6+ years. The guy that hired me to Uber, William Barnes, is my partner at Carmen. And when I left Uber, he was running the Uber Alumni Investment Club, and I joined him to get back into venture. Fast forward to today, we've raised over 250 vehicles, deployed around 170 million, and raised a $42 million pre-seed and seed fund. So basically, I've had to address many of the topics we're covering over 200 times.
Hey everyone, I'm James. Sorry I'm a few late. Um, Excited to learn from this discussion and to shed some light on a really hot topic within the allocator and GP world. I am new-ish to the allocator side of the table. It's been a year and a half since I've been with the McKenna team. McKenna is a multi-asset class endowment style allocator that spun out of Stanford's endowment management company about 20 years ago. Right now, full AUM is around 22 billion. The venture NAV is about 3.5, 4 billion. So we deploy 350 million a year, 80% into funds as an LP, and then 20% into directs, co-invest, secondaries, LP leds, GP leds, all the interesting permutations. So it's a lovely altitude to observe the market from this role. And my background is effectively one of late stage to early stage. So I was a buyout person in my past life at a mid-market firm in New York called Lee Equity. I spent a few years in a Series B through D land at a firm called 9 Yards Capital in Los Angeles, and then I spent about 4 years at Fika Ventures in Los Angeles, where I led the dev tools and vertical software practice with another partner there. So it's been a really interesting journey to now transition to this side of the table. So still have the GP empathy, hopefully, but you guys can be the judge of that.
Yeah, I'm excited to get into it. So I think we'll start off as we usually do with a poll question. The first one being, what best describes your current investing activity? So you all should see this. This helps us better understand who is actually joining this call, what your investing experience is, obviously, and then hopefully will help our panelists tailor their answers to various questions based off of where folks are actually at. So it's on the screen now for all of the attendees, and we'll give it about 10 to 15 more seconds for people to fill it out. I'll give it five, four, three, two, one. Okay. Okay, wow. Well, it's not surprising. Obviously, we're hosting this webinar, and obviously many folks find Sidecar for doing SPVs. So deal by deal investing is a large percentage, but so is running a fund and doing SPVs alongside it. So not too much surprising there. Great. Let's go to the next one. Um, we have, how do you currently structure fees on your SPVs? This kind of gets right into the topic of discussion for today. So I'm excited to see what folks have to say. think I'll start my countdown now. Five, four, three, two, and one. Okay. Both carry and management fee takes the lead, as does it varies deal by deal, which makes a ton of sense. And I think that's probably going to come up in today's conversation. Awesome. Okay. So as these poll questions show us, more and more managers are using SPVs as a primary investment tool as well as alongside their fund. But with SPVs becoming so dominant, fee decisions are coming up earlier and more often. So today's conversation is about how those decisions actually get made. To set the stage a little bit, Sidecar data shows us that the share of SPVs charging both carry and a management fee grew from 37% in Q1 of 2023 to 56% in Q1 of 2026. And carry-only deals dropped from 44% to 29% over that same period. So, Amr, I'll put this question to you first. From your seat as a GP, does that track with what you're seeing on the ground, and what do you think is driving that shift?
Yeah, I think it generally tracks. We don't necessarily match the exact same percentages as the overall sidecar data. We tend to skew a lot more to carry only. I'd say the biggest drivers by far is scarcity. And the last couple of years, there's been a ton of money being piled into very few companies, whether that's Anthropic, SpaceX, OpenAI, etc. They've all gobbled up such a huge percent of investable capital over the last few years. And I think that has driven the fee changes when it comes to like management fees, mainly because of the scarcity element. Um, and yeah, I would say like 3 years ago, we saw a lot more cookie cutter investment opportunities, simple pass through opportunities, not much work relating to like running the actual vehicles. So carry only felt more right. Today, a lot more dollars are being deployed into later stage companies, follow-ons and secondaries at a market level. Um, and what we have seen is that with a lot larger checks, larger rounds, there's just a lot more work, and that's where the management fees kind of come into play. Um, and yeah, we've shifted away from using carry only as the default, but it's still a heavy bias because I'd like to, as much as possible, be as aligned with LPs. When they make money, I make money.
Yeah, that makes a ton of sense to me. Um, James, before we even get to fees, what makes an SPV attractive or unattractive to you as an LP, when it comes to your desk?
Yeah, I think some of the biggest mediators there that are, I think, maybe outside the scope of the sidecar data are time to decision. Like we like to not be rushed ideally and can come in with a prepared mind. So perhaps there's even like breadcrumb trail of information and KPIs, diligence data coming in, weeks, maybe even months before the SPV goes live, so we can react quickly and with as much, pre-work references, market mapping, whatever done as possible by the time the SPV goes live. The second part is at least for us, the way that we think about the co-invest ecosystem is we like to draft off the best ideas in our rostered GPs from our rostered GPs. So if there's, a cap table that is already looking premier tier one names on there, like that just makes it that much more appealing. Obviously, FOMO is a currency in our venture ecosystem, and that's one proxy for it. If, something that Founders Fund and Thrive and Sequoia are all backing up the truck into, and we hear about that happening and we can play offense before that moment, that's quite opportune. Some of the other ones more related to secondary than primary funds is some sort of, embedded discount relative to a primary that's either recently happened or coming soon. So those are some of the, I guess, under the hood dynamics of what makes it appealing relative to the or over and above the fees and wrapper on it.
Got it. So it sounds like you prioritize SPVs coming from GPs that you're already invested in the fund, but it doesn't sound like you wouldn't consider an
So here's the
SPV.
thing. It's not actually that we do those GPs, SPVs. It's just that we like to see them in the round or exposed to the company already. So many of those GPs that I just named, like the tier one cohort, for lack of a better term, they have no incentive to offer those. Like they're not trying to curry favor with an incremental LP to come into a subsequent fund commit. They have all the capital that they could ever want. They can complete their fundraises in a weekend. The way that we run our co-invest in SPV motion is a lot of times it's the best way to get acquainted with a manager that we're in diligence with to try before you buy, if you will, and to get a taste for the way that they like to prosecute an opportunity, the way that they like to diligence and analyze something in their memos and quantitative analyses. So that's actually been something that's happened a few times where we've done an SPV with an emerging manager that has later graduated into a fulsome fund commit.
Got it. Yeah, that's really helpful. On Sidecar's platform, we've seen that smaller deals, so sub $1 million, are more likely to charge carry and then waive a management fee, while larger deals that are $5 million plus are more likely to charge both. And then early stage deals are one third less likely than Series A plus deals to charge both. So Amr, could you walk us through how you set fee terms on a deal? Like what factors go into that decision? And do you adjust depending on the deal size, stage, or the LP base you're bringing in?
Sure. Yeah, so generally pricing co-invest opportunities is a marketplace. Supply and demand of the opportunity really dictates the fees. And we've experimented a lot over 250 plus vehicles to see what maximizes commitments. But in general, I would say two variables do most of the work. One is scarcity of the allocation. How hard was it to get? And is the deal being quote unquote shopped around? A super hot company where we fought for allocation can bear higher economics, and LPs know it. And then two, who's the buyer? There's a universe of like 1 to 20K check writers versus the 500K to $20 million plus check writers from institutions or family offices. The largest check writers just expect more onboarding, more face-to-face time, more diligence questions, more data room access, more side letters, more comms, more IR, and this just drives totally different expectations. And in addition, our fund LPs generally get preferential terms and treatment for any co-invest opportunities we do. They're already paying us management fees, so we try to limit that variable and give them a discount on the carry. But as I said earlier, carry is the constant. That's my alignment. I get paid if they make money. And the management fee is the variable that flexes with the amount of work and admin related to like running the vehicle, etc. And yeah, from the you mentioned earlier, sub $1 million vehicles are only carry that generally tracks as I mentioned earlier.
Yeah, that makes a ton of sense. It's good to hear that you also have the fund that you're running alongside these SPVs. So that's why oftentimes management fees are zeroed out for existing LPs. Definitely a common thing we see.
One response or comment in response is I apologize on behalf of our my institutional LP peers who have the expectations around diligence and FaceTime and IR. So it's the timeline is also going back to the point I made before. Timelines are feel glacial relative to the GP side of the table where you have hours, maybe sometimes days to make a decision. I'm still calibrating to this new time horizon basis that the LPs, especially of the institutional variety, function on. So, and I also can empathize that when I was at this firm, 9 Yards, we had no committed capital. We were SPVing everything. So it was a lot of smile and dial, a hell of a lot of no's, probably like 95+% no's, just going through the lead list. So it's I think yeah, there's empathy on both sides of the table. It's not an easy thing to syndicate, no doubt, and doing it well definitely takes skill and asset selection too. So it's a full stack marketing plus underwriting job that is no easy feat.
Apology accepted.
And we're clear.
I love it. We're creating this is like the peace talks between GPs and LPs here. Um, Great. Let's hit the audience members with poll question number three. And I'm really interested in this one because it's only for the LPs in the room. So GPs, if you're about to click a button, stop right there in your tracks. For the LPs in the room, what's the biggest factor that makes you question a GP's fee structure? The fee level itself being too high, potentially, lack of transparency or explanation, inconsistency across deals, and fourth, fees that don't match the deal's complexity or access. I'll give it five, four, three, two, and one. Okay, great. A good number of answers here, with lack of transparency or explanation being the highest. And then that followed by fees that don't match the deal's complexity or access. Yeah, a bit of everything on the board, which is interesting to see. Um, I guess all of these are trigger points. Any comments, James or Amr, before we take this off the screen?
I think I'm curious, like lack of transparency, like does that mean you asked and it wasn't answered? Or like what is not explainable in that process? Like is are they evasive when you try to ask about it, the GPs who are marketing it? So I'd love to double click into what that actually means if there's anyone who can pop it in comments or something like that.
Yeah, I'd love that too. Amr, anything? Or we can continue on.
No, it makes sense.
Cool. Okay. Well, James, next question's for you. Let's go a little bit deeper on the LP side. When you see a management fee on an SPV, what's your first reaction? And what would a manager need to do or say to make it feel justified rather than opportunistic?
I think we very much understand that people need to make money and that these take time and money to set up and to run. So, we've definitely gotten our fair share of 0 and 0 SPVs. Many of those are with the rostered GPs, but also some of those are in that courtship GP camp that I talked about before, where they really want to just sweeten the deal and, you know, plant the seeds of a future partnership by doing an SPV. I think when we start to see the management fee creep up above, call it 3-4%, on an annual basis, or even, 5+% one time. I was just looking at one from a banker broker who I will remain unnamed that was 8% one time and then a 2% broker fee. So it's 10% one time. Like that just feels a bit aberrantly high. And this isn't even like a total consensus clear asset yet in the growth series B through D space. So there's obviously sliding scale based on how consensus the asset is. Like I saw, mid-teens management fees on Anthropic vehicles a couple months back. I'm pretty sure that market's still just as hot. Anthropic, OpenAI, maybe even Databricks, Stripe, etc. So I think we long and short of it is we'd much rather pay carry or even ratcheted carry, 10 stepping up to 20 or 20 stepping up to 30 above a certain return threshold than have a higher management fee because that's the most aligned component. And having to shave off, 5 to 10% just day zero of the investment with the hefty management or placement fee just does not feel good when we're writing the check. So it is what it is, just a higher bar to clear right out the gates.
Yeah, that's fascinating to hear. I've seen some articles talking about how more LPs are looking for GPs who have both the non-consensus early stage bet muscle fully formed, as well as connections and opportunities to invest in the consensus. And so it's like funny to hear a bit more of you talking about this deal that has what you're describing as like exorbitant fees, despite not being a clear consensus bet yet.
Definitely. Yeah, I think I would love to do more contrarian pre-consensus deals like that I think they have the higher upside skew. I think the LP ecosystem, if I could broadly categorize, and I'm sure there's nuances to this, but there's definitely more volume peeping into those consensus assets than folks willing to take a flyer or a risk on a Series A through C asset. So I think for the secondary ecosystem, SPV ecosystem to really flourish and not just be so top weighted, we need to have more risk tolerance. And, in our context, this is going to sound like crude math, but, we're doing $5 to $10 million bite sizes with these SPVs off of, like I said, 3.5, $4 billion base. If we lose it, we really won't feel it as much. But if we get the upside skew 5, 10x plus like that, that obviously will be great. So I think the backdrop of LPs of our similar size and scale, and we're but a tiny fish in the allocator pond on a magnitude basis. If you really think about who's out there, endowments, pensions, et cetera, there should be more tolerance for risk, and there should be more reaching for high upside scenario. So I hope that that happens going forward. I think that's just healthy for the ecosystem.
Yeah. Yeah, Amar, I know I would love to hear your thoughts on this. If there are deals that you're sharing that are kind of earlier stage, how you go about kind of relaying interest or like kind of a deal room to your existing LPs as well as like other contacts you're sending SPVs to.
Sorry, can you rephrase the question?
Yeah, I kind of we were just talking about how consensus bets are it seems like are much easier to share SPVs for. And so I'm curious, like what do you notice works well when you're sharing a deal that's true pre-seed, pre-consensus?
Yeah, so our fund does all pre-seed and seed, so we haven't done too many co-invest opportunities that early. Um, but yeah, I would say, I mean, for co-invest opportunities, the honest answer is like a lot of LPs want to know who the lead investor is, and that drives a huge amount of the potential interest. Like, is it a new lead investor? Are they tier one, etc.? GP commit plays a role, but I don't think it matters as much. Um, but yeah, if there's an allocation and we're trying to like quote unquote sell it, um, yeah, we just have to get on the phone more, explain the opportunity. But typically, who's the lead? What's the size of the opportunity? Who are the founders? That's all stuff that goes into our memos.
Yeah, that makes a ton of sense. And kind of throws the ball back in the LP court. Not that you have to answer, James, because I think you what you addressed is perfect. Like LPs maybe and GPs can get more excited about some of these pre-consensus bets.
Yeah, we're pretty clear that like we don't lead rounds. We're followers, and that means we're price takers, not price setters. Uh, and relying on the lead investor who has the fiduciary duty to the rest of the board and the rest of the cap table. Um,
Mm.
I think that's a pretty important variable.
That de-risks it for sure.
Yeah.
Yeah.
One other just narrative to tug on the from the allocator side is I'm seeing some folks in the comments saying like 2 and 20 feels standard. I think our that is standard for fee for fund commits for sure, no doubt. Like that is market standard, will continue to be, hopefully. No more inflation on that, though there are some folks charging premiums. The whole rationale from this seed where you're investing across funds and co-invest, which many like Stepstone, TrueBridge, pick your venture, fund to fund, is that they can rationalize doing directs co-investments because it's a better fee backdrop, like the 1 in 10 or 1 in 20 with a step up or 0 in 20. That the sometimes it's funny to say, but sometimes structure can dictate excitement level for an opportunity. If it's a 0 and 0 opportunity, that like just more palatable than a 2 and 20 for a co-invest. So anyway, just wanted to plant that seed with the crowd.
Yeah, for sure. I think it's a valuable one. Um, so I think we all knew that the conversation was going to get to secondaries specifically. And I wanted to share some sidecar data from our side. So 66% of secondary SPVs charge both carry and a management fee versus 42% of primary deals. And carry only is rare in secondaries. So only 14% of carry only deals secondaries apply for, and then 40% on primary deals. So, Amr, does that match your intuition? What do you think? Why do you think secondary skews so heavily towards charging both carry and a management fee as opposed to one or the either or neither?
Yeah, I think it comes back to scarcity and work. You know, a company that is even able to generate demand for secondaries likely is, a super hot company, quote unquote. Um, and yeah, who run the secondaries are also taking on more risk, so they counterbalance that with the management fees. A typical primary SPV inside a price round is largely like paperwork, and obviously like getting the allocations tough. And the price is set by the lead investor. We're just followers. As secondary, you need to find the seller, find the buyer, negotiate the price, clear the ROFR, make sure you don't mess with any of the company's ROFR/legal docs, coordinate the transfer, pay lawyers to set all of that up. And all of that needs to happen before we get any carry at all. So yeah, I think that definitely tracks.
Yeah, James, from the LP side, I mean, we touched on this and you gave examples of companies that you've seen on your desk, but for SPV investment. But what is that different standard that you hold secondary deals to?
Secondaries are, from my vantage, a bit more of a control your fate situation than an SPV that, many people may be driving exposure into. At least the secondaries that come to mind are ones where it's just a single seller and a single buyer, and it's not like a company tender where it's, tens or hundreds of millions of volume flowing through. So even though they may not be pref shares, they're common shares, but we control the fate of that exposure better than if we were just one of N folks in an SPV of primary shares. So that is nice, and theoretically, I guess we haven't seen this bear out, but we may be willing to pay a bit more to control our fate from a fee perspective on some of those secondary prospects. And there's definitely a lot more pricing arb on the secondary markets as well, especially if you reach into the, smaller blocks of secondaries where it's an idiosyncratic company insider, early VC who just like whatever has a health situation or needs to buy a home or is getting divorced, and they're willing to part with their shares for a lot, farther below the par value at that instance. So we've tried to play offense on those, but sometimes they're just too small for us. But there's still, I know, a whole universe of buyers who would love to come in at, 10, 20, 30% below the last round strike price. So secondaries are definitely an area where we play a lot of offense.
Yeah, that makes a ton of sense. Amr, how do you communicate your fee terms to LPs? And does your approach change when you're charging both carry and a management fee versus carry only? I know we talked about you sending deals to both existing LPs as well as folks who are not in the fund as well. So I imagine that communication may look a little different in explaining the fees.
Yeah, I think you just need to be super transparent. What are the all-in fees related to like carry, the vehicle's admin fees, setup fees, any annual admin fees, especially if you're partnering with if the vehicle is set up by an RIA, they have annual audits, and then any relevant management fees. So I think just being super clear about what the fees are on the investment memo is super important, especially if it's like a layered vehicle where the vehicle is investing into another vehicle. People
Mm.
ask a lot of questions around like, hey, this is what are my all-in costs? So I think you need to be super clear about that. And then yeah, in terms of like rationale, I think it goes back to like what I mentioned a few times. Apologies for being repetitive. It comes down to scarcity and work, and the scarcity element is more of a marketplace. Um, I wouldn't say we do a ton of explaining on why we're charging X fee, but we're always willing to have a conversation with an LP and discuss. And depending on the supply demand situation, is where we may be flexible.
Yeah. James, anything that raises a red flag when it comes to fees off the bat? I mean, you mentioned some examples earlier, but if there's anything else you wanted to add?
I think if the GP marketing the SPV doesn't have a grasp on the implications of the fee wrapper, or like what the dollars at work will be when you net out the fees, or what the ultimate gross to net spread will be, that to me is a yellow/red flag. And the question, like, what does a good explanation or marketing process look like? ideally we've talked about getting some diligence package or seeing some projections. Obviously, we don't want to see a, you know, 300x base case. So like realistic exit assumptions is definitely, you get points for that for not being, head in the clouds optimistic. Um, I think also having a gross to net waterfall in the returns is helpful just so it can, be concrete what's happening with the fee breakdown. So we see those in some of the models that we get on the co-invest front.
Got it. There's actually some interesting, questions in the chat, a ton of them. And Amr, I think I might punt one to you now. Um, Tom Darlington asks, are you ever using SPVs to help fill out a round for an early stage company? And if so, does that differ from an SPV for a consensus bet?
Um, yeah, I would say generally, uh, we we have set up co-invest vehicles alongside our fund investments a couple of times in the past, mainly because the founders really want access to it's almost like a marketing channel for them to get their company in front of a lot of former Uber operators. Um, so I wouldn't say we've used it to fill out a round. I would say we've used it to like help the portfolio company with getting the company out to lots of former operators who may join the company if they have roles. Like for example, we put a bunch of roles on top of a deal memo once, and that drove over 10 applications to the company. Or maybe it's a product that targets accredited investors, and it's more marketing for that opportunity. So I wouldn't say it's more to fill out around; it's more to provide incremental value.
Makes a ton of sense. Um, I think we have another question, kind of part of our regular scheduled programming. I think we've talked a lot about specific instances, but one thing, we'd love to hear one thing you'd tell an emerging manager who is setting fee terms on their next SPV for the first time.
I would just say charge carry, skip the annual fee, or skip the management fee. It's You're basically acquiring LPs for future opportunities, like if you want to raise a fund in the future. Basically, it helps you with building a track record and build out your LP list.
The
Great
only
advice.
only thing I'd insert is like just know who you're talking to, whether it's like the more retail, smaller check archetype or the, institutional fund committing with regularity, not idiosyncratically archetype, and you know, reflect the fee structure accordingly. It's a very enticing for the institutional allocators to get a discount in an exciting asset up front, and that only greases the wheel, so to speak, of a potential fund commitment. And that's how you whale hunt. And when the dominoes start to topple and scarcity gets created around either the co-invest SPV or a fund raise, then the rest of the dominoes will topple in our FOMO based world.
Yeah, that's great. Another really interesting question in the chat from anonymous attendee. If a GP is still fundraising for Fund 1, is it better to increase commitment to the fund or fund a deal via SPVs? The GP is a first-time fund manager. Any thoughts here from?
Sorry, I don't understand the question.
Yeah, like increase the GP commit to the fund or
Yeah, I think that's what they're saying.
fund a deal via SPVs. I mean, one, it's obviously good to have higher GP commit in the fund. Two, the SPVs can definitely accelerate the fundraise process if you're going to warehouse, any commitments within the fund to what is SPV. So I think they're kind of two separate factors. I wouldn't say they're that correlated, unless I'm misunderstanding the question.
But yeah, I think warehousing is good. It's a good
Yeah,
thing.
yeah,
Like
agreed.
if you have the money to like invest yourself, angel invest, and then warehouse it, you're basically fundraising off of with a portfolio that already exists. Like LPs are buying into a portfolio at cost, which I think is attractive to some LPs.
Yeah. Another question here is do fees reflect expected tenor, i.e., lower for a convertible note?
Think theoretically, yes. I haven't seen many convertible note SPVs, but that would make sense that
Like
there would be a
safes.
bit. Yeah, yeah. I guess safes. Yeah, yeah. That's your terrain, Amr.
Um, yeah, basically safes are typically used for early stage rounds or like bridge rounds. And I would say as particularly extension rounds, bridge rounds, however you want to call it, are likely not scarce opportunities. So I would say the fees should are more likely to be standard or no management fee at least.
Mm-hmm. Got it. There's another question that we got from a registrant ahead of time talking about a GP's AUM in reference to fees. And so the question was, at what point in a GP's AUM or track record do investors start accepting a management fee or single asset deals rather than expecting a pure promote? Any thoughts from either of you on that question?
Um, I think in general, like the more track record you have probably gives you more, I guess, quote unquote pricing power. But it really comes down to the deal itself.
Gotcha.
Yeah, nothing really to add there. I mean, I could reach for an argument that if you're on your second, third, fourth fund, then you don't need the incremental management fee and you should be more aligned on the carry side. But I think I could refute that just as easily. So,
Yeah. One last question for you both before we end out the webinar. How should a GP optimize SPV economics when the real objective is building a durable investment platform rather than maximizing revenue from each transaction? So I think, there's a balance that each GP holds in being able to use the fees in order to continue the fund operations, as well as SPV operations, and also in continuing to provide interesting deals and make it sustainable. So, is there anything else that you think the GP should keep in mind when sending deals to their to their LPs for longevity's sake?
one quick take is you could offer a stapled or mandate a stapled commitment between the SPV and the fund itself, which we've seen sometimes. We have not taken anyone up on those, but we do see that. And I know some people have taken the bait, so to speak, on an asset that they're really excited about. Okay, we'll pay we'll put some dollars up for the fund just so we can get into this asset. So, and sometimes it's a much higher ratio towards the SPV than the fund, which makes it a bit more palatable in theory because committing to a specific asset with higher quantum than a blind pool fund at a lower quantum. So that could work and that would be, aligned theoretically as well.
Anything to add?
Nope.
Great. Well, thank you both for your time. And I think we have a few other questions I see on kind of what are our metrics on the sidecar side, so we can follow up with folks on what we see. Appreciate your time.
Thanks, everyone.
Thanks for
Take care.
joining.
Have a good
Nice to
one.
meet you. Bye bye.